Welcome to Real World Real Estate, where we will explore, examine, and explain the real process of buying or selling real estate. Here is your host, Stephen Clyde.
Hey everybody, Stephen Clyde here, your host of Real World Real Estate with RE/MAX Preferred and RE/MAX at Cherry Hill. Today's podcast, we're going to talk about credit scores. Do you know how many credit scores you actually have? Because believe it or not, you have a lot more than just one credit score. We're going to talk about what makes up those credit scores, what has a bigger impact on your credit score, one thing over another, how different types of lenders look at your credit score completely differently, and what you can do to track your credit score effectively and how you can effectively work to increase your credit score. So for this discussion, I'm actually going to use my own personal credit scores as true examples. So if I go onto Credit Karma or Experian and pull up my credit score and get that, free report, it actually comes up as an 810 credit score. Now, if I go in and look at them individually, right, because I actually have three separate scores from three separate credit bureaus, Experian, Equifax, and TransUnion. They're the three credit bureaus. Now, what makes them different is different creditors don't report to all three of them. You may have a credit card with Macy's, and Macy's is only reporting to Experian and Equifax. They're not reporting to TransUnion. Or you might have had a bill open from a dentist for $50 that you completely forgot about and slipped through the cracks, and the dentist office put you in collection for $50, but that creditor, that collection agency is only reporting to Equifax, and they're not reporting to Experian or TransUnion, or vice versa. So your three scores can be completely different. It's very, very rare, and I've actually never seen where all three scores line up with each other. They're always different because of the way the creditors report to these three separate bureaus. So Credit Karma, I come up with an 810 credit score. Now, if I go into Experian, I see I have an actual 795 credit score. But if I look at my other credit scores, it's completely different. So my Experian credit score for a mortgage lender went from a 795 to, as far as a mortgage company is concerned, I have a 752. But if I'm going into the local Chevy dealership to buy a car, they're going to look at my credit score from the same credit bureau, and I'm going to have a 771. And if I apply to Discover Card or American Express or Capital One or Citi or anybody for a new credit card, and they pull my credit, they're going to tell me I have a 746. So there's 5 different credit scores I have, and there's a reason why that occurs. I didn't even mention the other one where all three of these bureaus have completely different scores on me. So, as I said, I've got that 795 with Experian. While on Equifax right now, as of today, that is a 759. So Experian 795, Equifax 759, TransUnion 780, Credit Karma 810. So there's 4 completely different scores coming up. And the reason being for this is the one for the 3 bureaus is because different creditors report different things to different bureaus. They don't all report to all 3 bureaus. The difference between the lenders that I mentioned, right? If I'm going to a mortgage company, I have this score. If I'm going to a car dealership, I have this score. And if I go to a credit card company, I have that score. Well, that's coming into play from the standpoint of the mortgage company is telling the bureaus that we want to see this criteria, right? And then the auto lenders may not care about the same things that the mortgage lenders care about. So they're looking at this criteria. And then the credit card companies have their own criteria. So your credit scores aren't all the same. They're not the same from all 3 bureaus, and they're not the same from every lender you talk to. They're completely different. And again, I've never seen any time where they all line up. Now, when you apply for a mortgage company does what we call a tri-merge. So they're going to pull your credit from all 3 credit bureaus simultaneously. And then when they review that, they're going to look at it and say, okay, we're going to drop the high score, we're going to drop the low score, and we're going to go with the middle score. So if we go back to mine, right, Experian is a 795, Equifax is a 759, TransUnion is a 780. So the mortgage company is going to drop the Experian, they're going to drop the 795 score. They're going to drop the Equifax 759 score. And as far as they're concerned, I have a 780, which is what we refer to as the middle score, obviously. Now, there's a lot of things that go into your credit score and what makes it up and what affects it more than other things. And we're going to talk about that a little bit and what your score ingredients are, so to speak. So your credit score is made up of 5 different criteria. Now, those different lenders put different weight on these 5 different criteria. So a mortgage company may look at your payment history and your amount of debt and your utilization of debt differently than the car dealer does and differently than the credit card companies do. But 35% of your score, for the most part, is made up of your payment history. So if you've never been late on anything and you've never missed a payment, then you're going to have an exceptional score for 35% of your credit score. Then the amount of debt is going to make up 30% of your credit score. So between payment history and amount of debt, we've got 65% of your credit score. Now, we're talking about the amount of debt. We're talking about the utilization of your debt. So if I have a $10,000 limit on my Capital One Venture card, the one we all see the commercials for on TV, if I have a $10,000 credit limit on that card and I'm carrying a $9,000 balance on that card, I have a perfect payment history. I make my payment every month like clockwork. I pay them 5 days early. So the payment part of that is going to be exceptional, but the amount of debt and the utilization part, that other 30% of my score, is going to go down drastically because I'm utilizing 90% of my available credit. What they really want to see is they want to see you utilizing 30% or less of your credit. So I'm not doing anything wrong, right? They've given me a $10,000 line of credit. I'm not using it all. I didn't go over my credit limit. I'm actually under my credit limit by 10%, and I'm making payments perfectly on time and sometimes early. But because I'm utilizing so much of it, they feel my cash flow must be short and I'm not making enough money because I'm utilizing so much of my credit. So they're giving me a negative report on that. So payment history, self-explanatory, right? Don't be late. Amount of debt is the utilization of the debt. Now, creditors are going to look at it at 2 different levels. So they're going to look at that Discover card that I was just talking about, right? I've got a $10,000 limit and I'm utilizing 9,000 of it. So 90% credit utilization. That's going to be a negative on that account, right? So that's going to bring my score down. But if I go out and let's say I call American Express and they give me their whatever the name of one of their regular credit cards is, not the normal platinum and gold American Express card that you pay every month in full, but they have some credit, or let's say Capital One, it's easier. We'll do another Capital One and we'll do the Quicksilver card, right? So Capital One gives me another credit card with a $10,000 limit, but I never use this one. So now I have $20,000 in available credit. I'm only utilizing 9 of it, so I'm less than 50%. That's going to give me a positive rating, but the negative on the account that I'm at 90% is still going to offset that positive. If I bring that $9,000 down to $2,500 or less than $3,000, then it's going to increase my score, right? So it's utilization as a whole and the amount of debt and my payment history. That's 65% of my score. Then length of credit history is 15% of my score. The longer my credit history is, the better that's going to be, and it's going to add an additional 15% to my score. The other piece is amount of new credit, right? So that makes up 10% of my score. And then we get into a credit mix. So if I'm new to establishing my credit, so if you're just graduating college or high school or whatever it may be, and you're opening up your first credit card, you're going to get a little bit of a negative on this 10% of the score because you only have a credit card or you have 2 or 3 credit cards, but you don't have any diversity in your credit mix. If we go back and if we would look at my credit report right now, we would see a car loan, we would see an automobile lease, we would see a mortgage, we would see my credit cards, right? We would see a home equity line of credit. I would have a full diversification of credit. So I would be getting a positive plus on the credit mix, that 10% of my score. Then the other part of this that they really don't give you a percentage as to how it makes up the score, but it has a drastic impact on your score, is collection accounts or derogatory public records. So again, you could have a $300,000 mortgage that you've been paying on time for the last 10 years, no misses. You could have 5 different credit cards, each with $10,000 limits, and you have less than $1,000 on each of them. So your credit amount is great. Your utilization is exceptional. You've never missed a payment on anything. So those are all huge positives. And you've got a mortgage and you've got the credit cards and you have a lease on a car or you have a car loan and you have a personal loan possibly. So you have a great credit mix. So on that initial surface, your score should be great, right? You've got good utilization. You've got a good diversification and a credit mix. Let's say you've had credit for 20 years. Your oldest credit line goes back 20 years. So you've got a good plus there. You've got the good mix. We've got great payment history. Everything's good. And we go back to that one dentist that you forgot to mail the check in and they put you in collections. And it could be a dentist or it could be your family doctor. It could be the radiologist. It could be an emergency room visit. Most times they're medical, but it could also be, hey, you missed a payment for Verizon on an old cell phone plan that you don't even have anymore, and you completely forgot about it, and they put you in collection for $45. Well, believe it or not, that one little collection account could have a 50 to 100 point hit on your credit score. So where you should have been, let's say you're my experience, you're at a 795. But then that $40 or $50 collection account for Verizon or the dentist or whatever it may be hits your report. Now all of a sudden that $795 just became a $695. Now, let's say for whatever reason, something comes up and you're in a dispute over somebody with something financial. If it's a contractor or a lender or a car, whatever it may be, and that person files a judgment against you in the court systems and they win. Well, that derogatory public record could have another 100 point hit to your credit score. So you're perfect on everything, but you got a $50 collection account that gets knocked 100 points off of your score. And there's a $100 judgment against you. Right. And it's for something stupid, but you're digging your feet in the sand. So you disagree with them and you're arguing it. So you're not going to pay that $100, but they secured the judgment against you. And now that 795 score has become like a 580 or a 590 score, or it's dropped drastically. This is what impacts your credit score. Now, what's interesting is that collection account may not be going to all 3 credit bureaus like I talked about. That collection company may only report to TransUnion. So you go into Experian or Equifax and you check your credit and everything looks fine. No problems. There's no derogatories there. There's no judgment. There's no collection. Nothing's going there. You don't think to check TransUnion. Or you check TransUnion and it's fine and you don't look at Equifax or Experian. until you go to apply for a mortgage and the mortgage company pulls all three. Then you learn that this exists. Now, paying off the collection may not change your credit score at all. The only way to get that to really impact your credit score and get it back up again is not only to pay it off, but to be able to negotiate with that collection company and that creditor to accept your payment and delete the collection from your credit report. Same thing on the judgments. They're court rulings and they're public records, so that's really very, very difficult to resolve and get removed. Same thing applies for bankruptcy, Chapter 7, Chapter 11, Chapter 13, or foreclosure. Those are all public record events that occur on your credit report. They have an extremely negative impact on your score, but they stay on your score, on your report, no matter what, for 10 years. So if you file bankruptcy, which there's no shame in it, it's obviously, our current president has filed bankruptcy more times than I can count right now. So obviously there's no shame in it. But you file bankruptcy for whatever reason. Maybe, you got furloughed and laid off during COVID-19. And now the unemployment part has run out and you can't find another job because of the current environment. So the only way to deal with this situation is to file for bankruptcy, which is, that's what it's there for. So you go in, you file for bankruptcy, you file a Chapter 7, and later on we're going to discuss with a really, really great bankruptcy attorney, Joel Spivak, the differences in bankruptcy, so I'm not going to go into that, but Chapter 7 basically wipes out your debt. At Chapter 13, you pay back your creditors over a controlled time frame working with the trustee, but I'm not going to get into the legalities and the differences between them. But let's say you did a Chapter 7 and that erases and wipes out all of your existing debt and you start back at zero again. You reestablish your credit. You go out and get, you're going to get new credit cards. They're going to be much smaller limits. You might get a $200 credit card and you slowly have to build it back up again. But even after you've reestablished everything and you've built back up your credit score, maybe you've got it up to a 600 or a 700, whatever it may be, that bankruptcy is still on your credit report as a derogatory public record. So that stays there for 10 years from the day your bankruptcy was discharged and finalized. So when the trustee leveled the gavel and cleared all your debt and discharged you from bankruptcy and gave you the clean slate to start from that date forward, 10 years, that public record stays in your credit report and it can't go away. Now, 10 years in a day, when that comes off your credit report, your score is going to go up significantly. Same thing applies for judgments. You may pay a judgment off, but the judgment is going to stay there for a specific period of time after it's paid off. I really don't know what that timeline is, and maybe we'll talk to the bankruptcy attorney about that. But that'll stay there for its required period of time. Now, when that comes off, obviously your score will go up. You can have a judgment for various reasons. And, I'm just going to speak on the ones I've seen. I'm not going to get into the legalities and the legal aspects of these judgments, but I've seen judgments against people for collection accounts that they never paid. And the creditor finally went to court and got a judgment against them. And so now it's not just a collection account, it's a judgment against you. And if you own a home or you're going to sell a home, all your judgments have to be paid off before you can collect your proceeds. So it could be for a credit account that you didn't pay off that just went to a completely different level beyond collections. A lot of what we see are child support judgments. So if you stop paying your child support for whatever reason, and again, we're not getting into that, but there are steps that can be taken by the courts to file a judgment against you. And that judgment, again, will remain on your credit until it's satisfied and for a specific period of time. Again, if you're selling a house, that judgment has to be paid off by the title company before they give you your check. I've seen judgments for sales tax for the state of New Jersey for people that own businesses, but they never paid their sales tax to the state, or IRS judgments because you didn't pay your tax bill, medical judgments, because your insurance didn't cover something you thought it was. Again, it went to collection, then it went to the next level, and they filed a judgment against you. So these items have a significant effect on your credit score. Obviously, you can control them if you keep them paid and stay out of those derogatory public record scenarios. But once you have them, you have to work diligently to get them removed and address them in your credit score because they don't go away. Ignoring them definitely does not make them go away. So again, we don't want any late payments. We don't want any credit cards going close to their credit limit. We want to keep that around 30% or less. We want a good mix of our credit. We don't want any collection or judgments against us. If we can avoid a bankruptcy, that'd be great. But that's what we're looking at. And when you see your credit score online, when you get the free one from Credit Karma or Experian or Equifax or TransUnion, they all offer a free one. I believe it's every year. I actually pay for a service where I can track it continuously. Keep in mind that it's not accurate, right? You have 9+ credit scores. You have the 3 credit bureaus, and then you have the 3 different ways that the different type of lenders look at your credit score and the criteria they weight. So again, the mortgage company may be looking heavier weighting on your payment history, your amount of debt, and your credit mix. The car lender they're just looking at payment history and length. Credit card companies probably putting a heavy weighting on the amount of debt and utilization and how you're using your credit. They're all looking for different things, so that score is changing significantly. If you're looking to get a mortgage and your credit score is going to determine the interest rate you're going to get, how much money you need to put down, it's going to have a significant impact on the mortgage you get. Now, it doesn't mean you have to have a over-the-top perfect credit score, right? Your credit score ranges from 300 to 850. Now, in my entire career, I've never seen a 300. I think to get a 300, you'd actually have to spell your name wrong, never pay anyone, not know your social security number. I actually can't imagine how you would get a 300 because I've seen people in bankruptcy with 500+ credit score. So I don't know how you get as low as a 300, but that's neither here nor there. Nor have I ever seen a perfect 850 credit score. I've seen just about everything in between. And where these ranges work from is, basically you want to be in the mid to upper 600s to the low to mid 700s is primarily where you want to be. All right. Because that's going to give you normal credit rating, right? That is, good, fair, or actually good to very good. Anything over an 800 is considered exceptional. Anything in the 750 to 800 range is considered very good. Anything in like the 650 to 700 range is good. And then below the 650 is fair. And I believe when we get into the 500s, that's when we go down to poor. But not every score is made up equally, right? So, you may have a 680 credit score, but your 680 is because of your utilization. You've got a great payment history. You have a great mix of credit, right? You've got the mortgage, you've got a personal loan, you got the car loan, you got credit card loans. You have the good mix. You've got a great payment history, but maybe your utilization is high, right? Maybe you're always carrying a high balance on those credit cards. And let's say you're in the 70 to 80% utilization range, but you're still paying everything on time. So that 680 score is completely different than someone that has a 680 score, but there's a bankruptcy on there. There's a repossession on there, or there's a foreclosure on there. So your credit score is the baseline, but then the underwriters and the mortgage companies look a little bit deeper to see what that score is made up of. So the 680 that's just utilization is going to be in a much better position applying for their mortgage than the 680 that doesn't have the utilization and they have no balances on the credit cards, but they had a bankruptcy 3 years ago, or they had a car repossessed 5 years ago, or they have that open judgment for child support or property or sales tax against them. That's going to be a harder loan to sell than the one that's just based off of utilization. So don't try and guess on your own what your credit score is, because what you see on Credit Karma or what you see on your free report from Experian or Equifax or TransUnion isn't necessarily, not even that, it isn't what the mortgage company is seeing when they run your credit. So before you start trying to clean up your credit and get your score higher, and I'm going to pay off this credit card, or I'm going to pay this credit card off, or I'm going to send the $100 to that medical collection, I would advise you talk to the lender first. Let them run a score simulator for you where they can say, all right, well, Steve's got a 650. If he pays down 50% of this credit card and he puts $4,500 on his Capital One to reduce the balance, what'll that do to his score? And then the simulator can run a simulation and say, okay, if he does that, his score is going to go up 20 points. Okay, well, what if he pays off this $100 collection account? Well, that may not change the score at all. Even though I paid it off, it may not change the score at all because the collection account is still there, like we talked about. Then they run it and say, well, what if he deletes and has the collection account removed? Well, then the simulator may say, well, it's going to go up 75 points or 100 points. So you want to sit down and talk to these professionals that really understand how this scoring system works so that you can best attack your credit score and maximize it and best use your available funds. So making that huge payment to the credit card company has an impact, but the bigger impact is going to be negotiating with the creditor that has you in collection and negotiate paying that off 100% and getting a deletion and a removal letter. Then these lenders also have the ability to take that information you've given them, send it back into the bureaus and do what they call a rapid rescore. I do want to talk about a myth when it comes to your credit score, and this is widespread. I will guarantee you that if you talk to 100 people that 100 people are all going to give you the wrong answer unless they happen to be in the industry and know what they're talking about. So that myth is, if I'm applying for a mortgage and I call 3 mortgage companies and they all run my credit, that's going to lower my credit score. That is 100% false. That is a myth. That is a sales scam from lenders. It is a myth that is busted and debunked. So credit inquiries absolutely can and will lower your credit score, but not when it comes to mortgages. The credit score is looking to see that you're good with money, that you're good with credit, and that they can trust you. That's what they're using the score for. So if you go out tomorrow and you're playing online and you get all these ads and emails, a low interest rate, an extra 50,000 points, from all these different credit card companies, and you go through and you apply to 10 of those credit card companies and all 10 companies run your credit, then yes, your credit score is going to go down from those 10 inquiries, because the bureaus know that you can now take out all 10 of those credit cards. You can get all 10 credit cards. You can all of a sudden be taking on $50,000, $20,000, $100,000 worth of debt because you just opened all 10 credit cards. You may not open any of them. You may have just did it and you wanted to see what they offered you. You didn't like the offer. You didn't take the credit card. Done. But as far as they're concerned, you could have. So they're going to ding you. If you start shopping cars, guess what? Every car dealer you go into that runs your credit bureaus assume, he can buy 4 cars. Absolutely. So those 4 inquiries are going to reduce your credit score. But they make the assumption that you're not going to take out 5 different mortgages at the same time. They understand that you are shopping for mortgages and you're looking at interest rates and closing costs and good faith estimates. So it doesn't matter if it's one mortgage company or 20 mortgage companies during that time frame. Those multiple inquiries are not going to ding your credit, right? You're going to get charged for one, but not for all 5 or 10 or how many you call, because you're supposed to shop for a mortgage. And they make the assumption you're only going to take out one mortgage. You're not taking out 10 mortgages, because the mortgage companies won't let you, because it'll blow your debt to income ratio out of the whack. And we'll talk about that later when we talk about pre-quals. So that's the biggest myth. So what you'll find is, and what you hear from people, and I hear it from unscrupulous, dishonest, snake salesman approach when it comes to mortgage loan officers, that you call them up and you want to get pre-qualified, and they say, okay, listen, we're going to approve you for, $200,000. This is the interest rate and this is our closing costs. But don't call any more banks, because if you call someone else and they run your credit, it's going to reduce your score. Then I won't be able to give you this loan. Well, I'm going to be blunt here. That loan officer just outright lied to you. 100%. That was a sales tactic to make sure that you did not shop his numbers. Anyone in the mortgage business that you're talking to get rates, to get interest, to get a pre-qualification that tells you that is a huge red flag that should go up to you, because they're not giving you a very good deal, because they don't want you to shop it. Because the truth is, like I said, you could talk to 10 mortgage companies. They're all going to run your credit. It's not going to ding your score. It's not going to reduce your score like all the other inquiries would do, because this is what a responsible, reasonable person does, is they shop for a mortgage. They just don't take one. So if you ever hear that from a loan officer, red flag, turn around, walk away, and call another professional and get a good referral to an honest, reputable, trustworthy lender and loan officer. But your credit score is complicated. It's needs to be managed. It needs to be taken care of, and it really needs to be monitored on a monthly basis. I'm looking at mine on a weekly basis just to stay on top of it. But monitor it, stay on top of it, talk to a professional before you start doing things to change it or increase it. So if you're going, for the mortgage, like I said, talk to that loan officer, let them run the score simulator, let them run it through the simulations and see what the best course of action for you is to raise your credit score. Find out exactly what your credit score is. Because remember, you're seeing one on Credit Karma or Experian. They're seeing 3 under different criteria than you're seeing. And they're going to drop the high, and they're going to drop the low, and they're going to keep the middle. So again, it's a guidance when you look at Credit Karma as to what your credit score is, but it's not your actual credit score. You have 9 to 12 different credit scores. So it all depends on what you're looking for credit-wise: car, mortgage, personal loan, student loan, all of that. So, it really needs a little bit of research, a little bit of attention, stay on top of it, study it, don't miss payments, don't go into collections. Obviously, these things are easier said than done. But listen, if you miss a payment on your Discover card once, let's say maybe the statement got lost in the mail and you paid in 35 days instead of 30 days. Well, the first thing you should do is call them up and say, listen, I didn't get my statement. Can we fix this? What can we do? Can you not report this? If they do report it, it's only going to be there for 12 months. So 13 months after that, no one's going to see that you missed that payment. All right. When they look at your payment history, there's a little chart that comes up that shows the last 12 months, and it shows X's if they were paid on time. And if they weren't, it'll show 30 for you were 30 days late. If you were 2 months late, it's going to say 60. If you were 3 months late, it's going to say 90 and so forth and so on. If it happened multiple times, it's going to show each one of them and each month that it occurred in. It'll do it on any type of account you have, be it your car lease, your car loan, your mortgage, your home equity line of credit, your credit card, student loans, whatever debt you have, it's going to show that payment history. But it's only looking back 12 months. So that's the plus. If you did have that hiccup, and it happens to all of us, over time, it's going to wash itself out. I want to touch base on something that's going on now, why we're in, the coronavirus and the COVID-19 is forbearance, right? Back in April, a lot of people took their mortgage forbearance for 3 months. Then after that, you were able to extend it for 6 months and then an additional 6 months. So for a total of 15 months, you could delay or postpone your mortgage payments. Doesn't mean they were forgiven. Doesn't mean they were wiped out. They're still there. You're just postponing them, right? But what's happening is on your credit score for those for April, May, and June, if you took the forbearance, it does not have a negative effect on your credit score at all because you didn't miss a payment. You weren't late on a payment. There was just no payment, right? So it's got a little dash in those 3 months. But if you're applying for a mortgage company needs to see 12 months of on-time past history with your mortgage. It's one of the Fannie Mae Freddie Mac guidelines that if you have a mortgage currently, to get a new mortgage, you have to have 12 months of on-time payments. Well, even though you haven't done anything wrong, you've properly taken advantage of a government program on this forbearance to protect us all during this time. So, your company shut down for COVID-19. You took the forbearance because you didn't want to fall behind on your mortgage, but you didn't have income coming in. So you did the wise and responsible thing and took advantage of it. Well, we've got those 3 gaps now, though, in your history. So you went back to work in July. You started making your mortgage payments July 1st. You're current. Well, that forbearance amount was set aside by the mortgage company and was set aside in a separate account that does not charge interest or accrue interest. It's just sitting there. You're not late on your mortgage. You're current as far as your mortgage company is concerned. When you pay that mortgage off, you still have to pay off those 3 payments that weren't made. Okay. But because of the guidelines, unless they change them in the future, you're back to work. Maybe you got a better job. Income's up, all good. But you realize during, the lockdown, the pandemic, you know what? I need a bigger house. I need a room for my kids to do homeschooling. I need a room to work virtual. I need to get a bigger house. Well, now the problem is when we go in to get you a new mortgage and the mortgage company runs your credit, they're going to get the notice that you're in forbearance and they can't give you a new mortgage unless you fully pay off the outstanding balance of the 3 forbearance payments or the 9 or the 6 or the 15, whatever amount of time it was. That has to be fully satisfied and cleared before they can underwrite you and approve you for a new mortgage. That's on the mortgage side of things. But you could have done the forbearance on your credit cards, on your car loans, on your car leases, every type of installment loan and credit was allowed the forbearance. The cars and the credit cards, I think they were limited to 3 months. They may have extended that, but as far as I'm aware, it was 3 months. But definitely check with your lender if you need that. So they're not going to impact you negatively at all either. They're going to be exactly the same as your mortgage. It's going to show the 3 blanks where the payment should be. They're not going to be marked late, but they're not going to be marked on time or paid. Instead of having the X that they were paid, they're just going to have 3 dashes there. Those payments just move to the end of your lease or your loan, or they're still, your balance didn't change with your credit card company. You didn't get a penalty. You didn't get any late charges. You were fine. Your balance didn't go down, and you have a skip of 3 payments. So that is having no negative impact on your credit score at all. And that really doesn't affect you 3, 6 months, 8 months from now when you go for a mortgage, as long as it's not in your existing mortgage. So if you were renting and you did those other forbearances, that shouldn't have any impact as long as you're back to making payments and everything's normal and you're working and everything's back to what it was pre-COVID-19, obviously. So those are things to definitely talk to a professional about as well. In the coming weeks, we're going to have an interview with Jim Reed from Green Tree Mortgage, who's probably one of the best loan officers I've ever come across. I've known him for 17 years. And Jim's quirk is in his free time, he likes to sit down and read the Fannie Mae, Freddie Mac, and HUD guidelines for mortgages. So we're going to talk about the pre-qualification process, and we're going to dive deeper into the FICO score and the credit score and how they're looking at it and what those changes are that they're looking for. And we're definitely going to dive into this forbearance situation that we're facing right now. Also, we're going to be doing an interview, as I mentioned, with one of the premier bankruptcy attorneys here in Cherry Hill, New Jersey, Joel Spivak. And we're going to discuss, the difference between Chapter 13, Chapter 7, Chapter 11, what's the differences between these types of bankruptcies, how they affect you, what effect they have on your house, on your car, all those types of things. We're going to really dive deep into with Joel into the bankruptcy process. And we also have an interview coming up with Randy Vonderton from Edgewood and Associates, which is a local insurance broker that we've known for years. He's actually third generation insurance broker. But we're going to talk about, because you probably don't realize that when you apply for car insurance or homeowners insurance or renters insurance, motorcycle insurance, boat insurance, whatever it may be, they're using your credit score to help set your premium. So that's why this credit score is so important to monitor and stay on top of, because that stupid little $50 collection account that didn't seem like that big of a deal, but just dropped your credit score by 100 points. Well, that may have been I don't even know what percentage it would be, but that may increase your car insurance, your renter's insurance, your homeowner's insurance. It's definitely going to increase your cost of a mortgage. So credit score is extremely important. It's used for just about everything. So it's something that we have to monitor. We absolutely should understand. We should know what it's made up of, what these three bureaus are and what the differences are, what effect each little thing has on the score, because this score has a major, major financial impact on just about every aspect of our lives, from our cars, our transportation, to our houses, our shelter, to our insurance, our protection. Everything. It may even have an impact on employment. I definitely know if you're looking for security clearances, and some different industries use credit reporting as part of their screening process for employees. So this number that most people do not understand, or understand how many numbers there are and what makes it up and how you can manage it, has such a huge impact on your life, from work, shelter, transportation, protection. Every aspect of your life is affected by this number. So you have to understand it. You have to monitor it. You have to stay on top of it. So we're going to dig into this deeper, like I said, as we go into the mortgage side of it, as we talk to the bankruptcy attorneys, and we're definitely going to dig into it from the insurance standpoint. So I look forward to coming back to you guys with those interviews, and I hope you had a great day and enjoyed this, and I hope it helped you. But definitely sign into Experian, Equifax, and TransUnion. We'll put the links in the show notes. Start looking at your credit score. Just don't use Credit Karma. Start looking at it. Start monitoring it. A couple of these sites actually have score simulators where it can tell you, hey, if you pay off $3,300, your score can go up by 50 points, whatever it may be. But I know they have systems where you can plug it in, continue to pay your bills on time, forget to pay a bill, don't pay any bills. If you declare bankruptcy, if you pay off credit, if you get a new credit, there's probably 15 to 20 different scenarios you can plug into these simulators, especially on Experian, and it'll show you the impact that that's going to have on your credit. So it was great coming to everybody today. I'll talk to you all next week. I'm looking forward to it. Enjoy the end of summer. Stay safe out there. Practice your social distancing. Have a wonderful